2:17 a.m. Your screen is glowing. Silver is screaming higher. The chart looks like a rocket. Then it freezes. No prints, no bids, no escape. Like a casino that locks the doors right when you're about to cash out. And you feel it in your gut because you've seen this movie before. Not in silver, in your life, in 2008, in 2020, in every once-in-a-lifetime crisis that somehow keeps happening. The system doesn't break in daylight. It breaks after hours. It breaks on weekends. It breaks when you're asleep. And the next morning they stand at the podium and say, everything is stable. Stable for who? Here's what most people never learn until it's too late. Silver doesn't just trade. Silver is managed by rules, by switches, by emergency levers, rules that don't hit everyone equally, rules that show up only when the public finally wakes up and rushes the exit at the same time. CME, COMEX, the paper silver arena. They call it risk controls. They call it market stability. Sounds responsible, but the effect is always the same. When silver starts to run, they raise the cost to stay in the game. They cap how far it can move. They force traders into a corner, margin hikes, price limits, trading halts, a trap door under the feet of anyone using leverage. And if you're 55 plus, retired, living on savings, you need to understand this now. Because when the system is under stress, they don't protect you. They protect the system. And the most dangerous lie you've been told is this: the price of silver is just supply and demand. No. In the paper market, the price is also permission. Permission granted by the rulebook, and permission can be revoked fast. Now listen closely, because this is where most people get hypnotized by the headlines. They see a big move up. They get excited. They think, this is it, the breakout, the real price. Then the rules change, and the breakout becomes a beatdown. Not because silver failed, because the trap was sprung. So let's talk mechanics. Not opinions, not internet rumors. Mechanics. A standard COMEX silver futures contract represents 5,000 ounces. 5,000. That's not a handful of coins, that's a truckload of metal. And futures are built on leverage, meaning you control a giant position with a fraction of the money. That fraction is called margin. CME calls it a performance bond. Cute name, like you're renting a tuxedo for a wedding, but it's not a tuxedo, it's a leash. And when they tighten that leash, people choke. Here's the part retirees need burned into memory. In futures, you can be right and still get wiped out. Because you don't lose when you're wrong. You lose when you can't pay. And in a margin system, payment can be demanded overnight. Now think about late 2025 into early 2026. Silver started ripping. The mainstream finally noticed. The sleeping herd started asking questions. That's when the game always changes. CME issues a notice, margin requirements go up. And right after that, silver gets hit hard. Because the moment margin rises, everyone holding leverage positions has a problem. They need more cash. Right now, not next week, not when you can. Now. And if they don't have it, their broker liquidates them, forced selling. At the worst time, it's like being on the Titanic, finally finding a lifeboat, and someone charges you a fee at the ladder. Cash only, no credit. Let me give you a scene that feels painfully real. A man in his late 60s, smart, cautious. He isn't a gambler. He buys one silver contract because he wants exposure. He's thinking, it's only one contract. I can handle that. Silver starts running. He's up. He's relieved. He tells himself, finally, a hedge that works. Then a notice hits after the close. Margin requirement increased. He doesn't even see it until morning. At 8:12 a.m., his phone rings. It's not a friendly call. It's a clerk, a script, no emotion. You need to wire additional funds today. He says, how much? They tell him a number that makes his stomach drop. He says, but I'm up on the trade. They don't care. That's the point of margin. It doesn't care if you're up. It only cares if you can pay. He says, give me until tomorrow. They say, we can't. And while he's still talking, the position is being reduced. Sold. Not at the top, not at his chosen price. At the market's worst moment, that's what a containment move looks like in real life. Now, I want you to understand why these rules exist. CME is tied to a clearinghouse. A clearinghouse is the middleman that guarantees trades. If someone can't pay, the clearinghouse is on the hook. So the clearinghouse becomes obsessed with one thing: collateral. More volatility equals more collateral. So when price starts moving fast, they protect themselves first. They call it prudence. But it means the system's first instinct is to squeeze cash out of participants. And cash is scarce during a panic. That's why it works as a brake. Now here's the 3-step playbook. Step 1, let excitement build. Let headlines spread. Let the herd lean in. Step 2, raise margin, force selling, trigger fear. Step 3, use limits and halts to control the speed. So the public can't all rush through the same door at once. It's not magic, it's plumbing. And if you've never studied the plumbing, you think the flood is random. It isn't. So what does a margin hike really do? It forces the weak hands to sell. It drains fuel from a rally. It breaks momentum. It creates a headline. Silver crashes. And the herd panics, exactly on schedule. Now, let's put numbers to it so it's real. One contract is 5,000 ounces. That means every $1 move in silver equals $5,000 of profit or loss. 5,000. $1. So if silver moves $10, that's $50,000. If it moves $20, that's $100,000. Now imagine you're on the wrong side, or even the right side, but you don't have extra cash sitting around. A violent move happens. Volatility spikes. CME raises margin. Suddenly you're required to post thousands more per contract. You don't have it, so you're sold out. Not because you chose to, because the system chose for you, and that's only weapon number one. Weapon number two is quieter, more surgical. Price limits. A price limit is exactly what it sounds like. A ceiling and a floor. A maximum range of contract is allowed to move in a session. And when the market hits that limit, trading can pause, halt, or get restricted. Translation? If silver is exploding higher, the exchange can slow the explosion. They can turn a sprint into a crawl. And when a market can't move freely, behavior changes. Liquidity dries up, spreads widen, orders don't fill normally. The free market turns into a hallway with locked doors. And here's the sick truth. The futures price is the reference price the world watches. Spot headlines, ETF pricing, mining stock reactions, dealer premiums, all of it. So the most important price on the planet for silver is sitting inside a system that can slam on the brakes at will. Now, before we go further, I want you to notice something. Every time the public gets interested, the rules get stricter. Every time momentum builds, the cost of participation rises. That's not an accident. That's design. They don't need to ban buying. They don't need to outlaw enthusiasm. They just make it expensive and difficult to keep pressing, and then they call it stability. Stability is a beautiful word, like safety, like protection. But sometimes stability is just a cage with good lighting. Now connect it to your life. Inflation isn't a headline to you. It's the grocery bill, it's property taxes, it's insurance premiums, it's the cost of living that never goes back down. And if your wealth is mostly pensions, 401ks, bank accounts, and bond funds, then your wealth lives inside their system, inside the same machine, the same casino, the same Titanic. And when that ship tilts, you don't want to be the person asking where the lifeboats are. You want to already be in one. This isn't a theory, this is math. Now comes the part nobody wants to imagine. So I'm going to force it. Imagine this. You wake up on a Monday. The news says, emergency measures. Banks are fine. Markets are orderly. And then you notice something weird. Your card doesn't work at the gas station. Not declined, just stalled. System error. You try another. Same. You go home and log in. Your account is there. But transfers are temporarily unavailable. And the talking heads tell you to stay calm. This is how modern control works. Not with soldiers, with switches, with permissions, with rules that can be flipped in one weekend. And if you think that can't happen here, ask yourself a simple question. Have the rules changed in your lifetime? Yes. Have banks done things you never imagined? Yes. Have politicians promised things and reversed them later? Yes. So why would the money rules be sacred? They won't be. Now look at the direction the world is moving. More surveillance, more digital tracking, more compliance, more we're doing this for your safety. And if the day comes where money becomes programmable, then your spending becomes conditional, approved, denied, limited. Imagine this. Your pension hits your account, but it comes with conditions. You can spend X on food, X on gas, X on medicine. And if you try to buy something unapproved, it fails. Not because you're broke, because you're controlled. You don't need to love conspiracy theories to see the trend. You just need eyes. And when that shift happens, retirees get hit first. Because retirees can't just work more hours. They can't ride it out for 15 years. They need stability. They need certainty. But the system doesn't offer certainty. It offers promises. And promises break. Now zoom back to silver. When people lose faith in paper, they run to hard assets. Gold, silver, anything that isn't someone else's liability. And that's exactly when the paper system gets stressed. Because paper silver is massive. It's contracts, it's leverage, it's bets on price, not necessarily metal in hand. So when a stampede starts, the system has two choices. Let price explode and expose the shortage, or slow it down with risk controls. Guess which one protects the system? So what do they use? Margin hikes, price limits, trading pauses. They contain the panic, they manage the optics, they buy time. And time is everything, because time lets them negotiate behind closed doors. Time lets them move risk around. Time lets them get their friends out of the burning building before the public smells smoke. This is the US versus them moment. Us is the awakened few, the people who study the rules, not the headlines. Them is the corrupt system, the institutions that write the rules and pretend they're natural laws. Now here's the trap for the sleeping herd. They wait for confirmation. They wait for the perfect headline. They wait for the perfect dip. And in that waiting, they stay in paper. They stay in accounts. They stay in promises. Imagine this. Silver gaps up in the night, then freezes at a limit. Your order doesn't fill. Before the next session, margin requirements jump again. Now your broker sends a message. Deposit additional funds by 10 Orange AM. You don't have extra cash sitting around, so you sell something, a stock, a bond, a position you wanted to hold for retirement at the worst possible time. Now multiply that stress across the market. Liquidations cascade, prices whip, and retirees watch their safe portfolios swing like a wrecking ball. That is the trap. And here's the cruelest part. After they contain the run, they use the drop to mock you. See? Silver is volatile. See? Metals are risky. See? Just stay in your balanced portfolio. And don't miss the psychological trick. They don't just hit price. They hit confidence. They make normal people feel stupid for wanting protection. They turn a legitimate escape route into a shameful speculation story. So you give up. You go back to paper, and they keep the herd asleep. Meanwhile, the balanced portfolio is balanced on a single promise. That the currency holds. That the system stays honest. That the rules stay fair. But when debt is this big, when the cost of living is this high, when confidence breaks, rules change fast. And the people who suffer are the ones holding paper claims, not bearer assets, not real metal, not something you can hold without asking permission. So what's the exit? Not a prediction, not a hot trade, a position, a defensive position, physical gold and physical silver, not because it's exciting, because it's outside the trap, because physical metal doesn't get margin called, a coin doesn't get a maintenance requirement, a bar doesn't get liquidated because some committee raised the collateral threshold, a stack in your possession doesn't care what CME does this week. That right there is the difference between a toy and a tool. Paper silver is a tool for traders. Physical silver is a tool for survival, freedom, independence, bearer assets. Now I want you to tattoo one phrase onto your thinking. Counterparty risk. It means this. If your asset requires someone else to perform, someone else to pay, someone else to stay solvent, then you don't fully own it. You own a claim, and claims fail. Banks can freeze. Funds can gate redemptions. Brokerages can restrict trading. Exchanges can halt markets. The rules can change, and you will be told it's temporary. Temporary has a way of becoming permanent. But a physical ounce? No counterparty, no permission, no password, no policy update? It's yours. Full stop. That's why real metal has been money for thousands of years, because it's the opposite of a promise. It's a thing. And in a world drowning in promises, a thing becomes priceless. Now, I'm not telling you to panic. I'm telling you to prepare, because panic is what the herd does. Preparation is what the awakened few do. The herd waits for official permission. The awakened move before permission is needed. And here's where we make this personal. You worked decades. You saved. You sacrificed. You delayed gratification. You did what you were told. And the fear that keeps you up at night is simple. What if the rules change right at the end? That fear is not irrational. It's realistic. Because that's what systems do under pressure. They protect themselves, not you. So you build your own lifeboat. You reduce counterparty risk. You diversify out of paper promises and into possession. This is what I mean by be your own central bank. A central bank can create money out of thin air. You can't, but you can do the next best thing. You can store value in a form that can't be printed, can't be diluted, can't be clicked into existence. And when the day comes that markets go limit up, limit down, when margin spikes, force liquidations, when you hear the words temporary restrictions, you won't be the person staring at a frozen screen. You'll be calm. Because your protection isn't trapped behind a login. Now, let's close the loop. Why does CME contain a silver run? Because a runaway silver price is a spotlight. It shines on inflation. It exposes currency weakness. It signals panic. And panic is contagious. So they don't stop it with speeches. They stop it with mechanics. They raise margins. They tighten limits. They corner traders. They shake out leverage. They cool the public's excitement. Then they declare victory. Order restored. But here's the insider truth. Order isn't restored, it's postponed, like putting duct tape on a pressure cooker. It holds until it doesn't, and the day it doesn't, the herd will stampede for the same door. At the same time, in the dark, the door will be narrow. So here's what you do. You don't race the herd, you get positioned early, you build a small, quiet fortress outside the system. Not to get rich, to stay free, to stay liquid in real terms, to protect purchasing power when paper lies. If you want to survive what's coming, subscribe to AG Finance Family. Not for entertainment, for awareness, for preparation. Because the people who win the next chapter won't be the smartest. They'll be the earliest. One last thought, and I want it to haunt you. In a good way. A trapped animal doesn't lose because it's weak. It loses because the trap is engineered. And the paper silver market is a trap built with rules. Margin hikes, price limits, and panic contained on command. Don't be the sleeping herd. Be the one who saw it first.